Hello everyone, I'm Josh Garrett, and in this video, I'm going to be talking about mutual funds. In this video, we're going to be talking about, first of all, what are mutual funds, second of all, actively managed and passively managed funds, and finally, we're going to be talking about the advantages and disadvantages of mutual funds. First of all, what are mutual funds? A mutual fund is an investment vehicle that pools money from multiple investors to purchase a diverse portfolio of stocks, bonds, or other securities. This is managed by professional portfolio managers, and mutual funds provide individual investors access to a broad range of investments that they could not have achieved on their own. Now, this explanation might have been a bit confusing, so to explain it better, I'll take an example. Let's say John is a really successful investor. It seems anything he puts his money into always does well. Seeing John's success, all his friends are asking John to teach them and give them tips. Now, John is tired of answering each and every question again and again, so he decides to start something called a mutual fund. He asks all 10 of his friends to give him $100 each, and he will invest it for them in the best places. Now, totally he has $1,000, and he invests it in a diverse portfolio of stocks, bonds, and other securities that appear to be profitable. Now, in 1 year, he has grown the money from $1,000 to $1,100. Now the value of each unit has grown from $100 to $110. What I mean by this is that each friend had invested $100 and now it has grown to $110 each. Now, if anyone has to buy some units, they have to buy directly from John's friends, and they can't just be added into the mutual funds just like that. This is mutual funds. Now let's talk about NAV, which is like the most important thing you have to know about mutual funds. Now, in the example, you might have noticed I said the $100 to $110 per unit. This is called NAV, or net asset value. NAV's formula is basically total assets minus total liabilities divided by total outstanding shares. In John's case, he does not have liabilities. His total assets come up to $1,100 at the end, and because of this, the formula is $1,100 minus $0 divided by 10, which is $110. The net average value is useful because it's used to determine the current market value of an investment fund's net assets. Now, the net average value, or the NAV, is very useful because it's used to determine the current market value of an investment fund's net assets. This may differ from its current share price. Now, another thing which you might know or might need to know is actively managed and passively managed funds. Active management refers to a mutual fund scheme in which the fund manager actively manages the portfolio, just like it's called. He continuously monitors it, deciding on which stocks to buy and which stocks to sell and which stocks to hold on. And then they use their professional judgment backed up by analysis. An active fund manager seeks to outperform the scheme's benchmark and generate maximum returns. Then we have a passively managed fund. By contrast to the active management, it simply follows a market index. For example, the fund manager remains inactive or passive in as much as he or she does, and does not use his or her judgment or discretion to decide which stocks to buy, sell, or hold, but rather they replicate or track the scheme's benchmark index exactly as it does. An index fund and all exchange traded funds are examples of index funds. The goal of a passive fund manager is to simply replicate the scheme's benchmark index, generate the same returns as in the index rather than outperform it. Now, what are the advantages and disadvantages of mutual funds? First of all, mutual funds offer diversification. Now, if you have a little amount of money, you might not be able to buy stocks, bonds, and securities and everything like that. But mutual funds invest in a variety of assets, reducing the risk associated with any single investment. Then we have professional management. You have experienced portfolio managers who make investment decisions, which can benefit investors who lack the time or the expertise. Then we also have accessibility. Mutual funds allow investors to invest in relatively small amounts of money, as I said. So with just small amount of money, they can have a diverse portfolio. Finally, we have variety in advantages. There are numerous mutual funds available, catering to different investment goals, risk tolerances, and sectors. Now that you know the advantages, what are the disadvantages? These are the fees and expenses. Mutual funds charge management fees and other expenses, which can reduce the overall returns. Then we have lack of control. Investors do not have direct control over the individual securities within the fund. Then we have the performance variability. Not all mutual funds will perform well. Some underperform the market or their benchmarks. And finally, we have the conflict of interest. The interests of fund managers might not always align with those of the investors or you. Managers might take on excessive risk to achieve higher returns and bonuses or to attract more investors, sometimes compromising the long-term stability. Which is why it's important for you to understand who is managing and what decision they might make, and investing on a mutual fund by analyzing that. I hope this video is going to be useful to you, and if you really like this video, please like and subscribe. Bye.